Hello, this is ChewDog Charts, and today we're going to take a look at some stock warnings. These are caution signs on the path to investing. Now, you're not going to get any caution signs or warnings from institutions simply because they never do. Banks won't warn consumers because they need the consumers to spend money, make loans, and invest in money markets. And governments won't warn people for the same reason. They need people to spend money. And certainly, central banks won't warn consumers because they're in the confidence game. However, there are some out there, like me, who will help provide some caution signs. So let's take a look. My purpose here is to provide you some unbiased, objective information. Even though some of my bias may come through, that's not my intent. My intent is to provide you this information so that you can come to your own conclusions with regard to your life and your investing. But right now, there's caution signs out because the underlying data of the economy doesn't look good. So the problem is that despite all of the global central bank efforts to stimulate growth, real growth has never emerged. Now, we've got $20 trillion sloshing around, yet the economy is not doing very well. As you can see in this chart from the St. Louis Fed, real gross domestic product, it's not looking very good. Back in 1990, we were at much higher levels, as well as in 2000 and even in 2005. Yet with all the stimulus after 2009, we're just trundling along at lower levels. What's going on in the economy? Let's take a look at some more information. Do you remember when the central bank supposedly said they were going to begin reducing the quantitative easing in 2018? And in fact, in September, the Fed told everyone that they would start reducing their balance sheet in October. Well, it's mid-November. I haven't heard much. But here's a chart showing basically what the forecast is for the central banks. The US, Japan, the Eurozone, and the G3 total. Again, information directly from the St. Louis Fed. This is the commercial and industrial loans, all commercial banks. No matter which way you look at it, we're in a slowdown, much lower than we were prior to the 2008-2009 crisis. And in fact, we're almost going negative. So no matter how you look at it, it's not looking positive. This chart here is the same as the previous chart, with the exception that this is commercial and industrial loans, foreign-related institutions. This does not look all that hot either, and in fact, it's already negative. Here is a quick look at real estate loans, all commercial banks. Looks like we had a bottom in 2010, 2011, increasing through 2016, but it looks like we've had a slight downtrend beginning in 2016 and through today. This is a follow-up to the previous slide, and this shows existing home sales. From November 2016, the peak, to now we've gone negative as of September 2017. Now these next two charts show the real problem. This chart, consumer loans, credit cards, and other revolving debt, basically went sideways more or less through 2012 into 2014. In early 2014, though, the debt started to pile on. Now, if we're supposed to have a global synchronized growth going on, then why is the consumer increasing the credit at such a rate? To me, the consumer's Let's take a look at the next chart. Now remember, the previous chart showed the consumer loans, which was the credit cards and revolving debt, heading up. This chart shows consumer loans, but other consumer loans, such as automobile loans. Now, the other chart was heading up, and this one is heading down. This is almost into negative territory. So what's going on? Essentially, the people are struggling and they're borrowing on their revolving debt in order to stay afloat. These two charts are diametrically opposed. They're showing you that you and I, or the average consumer, is not getting ahead in this so-called growth economy. And then how about this? How's your personal savings? This chart shows that we are above 6%, and now we're down below 3.5%, heading to 3%. Now our savings rate is going down, and our debt with consumer revolving credit debt is going up. Tells you a story that things are not good. Well, there is one possible bright side, and that's if our savings, or more particularly, our real disposable personal income is going up. But no, we were above 5% in January 2015, and now we're barely above 1%. Now, perhaps lately, you've heard about all the retailers like Sears, Macy's, and others having difficulties. It's the Amazon effect, they tell you. Well, taking a look here, this is a chart showing the retail trade sector with regard to employment. And notice that in the last 3 periods, when the employment change went negative, we had a recession. Now, I find this chart particularly interesting. Shows the civilian labor force participation rate in red and the civilian unemployment rate in blue. Now, the participation rate peaked in around 2000 and started to drift off into the 2008-2009 crisis, at which point it fell quite dramatically. And then the unemployment rate peaked at a high of about 10% in 2010, and that it has steadily declined at a fairly steep rate through now, and unemployment is showing about 4%. But what I find interesting in this chart is that in 2010, both the unemployment rate and the participation rate have fallen fairly dramatically and somewhat in correlation. And lastly, if you don't believe me, then the St. Louis Fed is telling you that the real potential gross domestic product expectations into 2027 is anemic, under 2%. Now, does this mean we're going to have a stock market crash? No. But is there a possibility of a contraction, a recession? Perhaps yes. So again, the Buffett rules of investing: never lose money is rule number 1. And rule number 2, don't ever forget rule number 1. Be cautious. This is ChewDog Charts. Thank you.